Welcome back to our class. In this video, we will discuss IPO pricing techniques. A critical step in IPO pricing is evaluating the equity value of the issuing firm. Two valuation techniques are frequently used. The first one is comparable company analysis, and the second one is discounted cash flow analysis. In a comparable company analysis, the first step is to select the comparable companies. This work is relatively intuitive. Companies in the same industry with similar size may be good comparables. Other key characteristics to compare may include the products, the customers, geography, profitability, and growth opportunities. After selecting a few comparable companies, financial multiples of comparable firms are used as benchmarks to estimate the market value of the issuing firm. The most widely recognized multiple is the P/E ratio, which is calculated as share price divided by EPS. EPS is earnings per share. We can see this ratio is equivalent to equity value divided by net income if we multiply the number of shares outstanding to the numerator and denominator. Using the P/E ratio of comparable companies, the equity value of an issuer can be estimated by multiplying its projected net income after IPO with comparable P/E ratios. For example, let's say we have a hypothetical company, ABC. ABC plans to raise $3 billion from its IPO. The raised fund will be used to help company ABC finance its core business and help the company expand its business globally. Company ABC is projected to generate net income of $400 million in its last financial year after IPO, and the P/E ratio of comparable companies is 30. The equity value of company ABC should equal net income projection multiplied by P/E ratio and equal $12 billion post-IPO. And the equity value of company ABC before IPO should equal the difference between its post-IPO value and the value of fund raised from IPO, which equals 12 minus 3 and equals $9 billion. If company ABC has a total number of 300 million shares outstanding before its IPO, then the share price of ABC should equal 9 billion divided by 300 million and equal $13 per share. And we can also calculate the number of new shares issued in this offering, which equals the value of raised fund 3 billion divided by the share price $13 and equals 100 million shares. But equity value obtained with P/E ratio can have several limitations. Firstly, comparable analysis using P/E ratio is not feasible for firms with very little earnings or negative earnings. Some high-tech firms are yet to make a profit at the time of IPO. Next, net income and EPS are influenced by the capital structure of a firm. For example, two very similar firms can have huge differences in their net income due to differences in leverage. Lastly, differences in accounting policies for depreciation can also result in discrepancies of P/E ratios among comparable companies. Another widely used multiple is EV divided by EBITDA, which is calculated as enterprise value divided by earnings before interest, taxes, depreciation, and amortization. Enterprise value is the sum of all ownership interests in a company, including both debt and equity. EV to EBITDA multiple is feasible for companies with negative net income and is also not influenced by differences in capital structures. After obtaining enterprise value, equity value can be calculated as the difference between enterprise value and net debt. Comparable company analysis is a market-based valuation technique, in that the ratios of comparable firms are influenced by current market conditions. If the market is very bullish, comparable company analysis may overestimate the value of a company under market exuberance. Another frequently used technique to evaluate a firm is discounted cash flow analysis, or DCF analysis. DCF analysis is based on the principle that the value of a firm should equal to the present value of its future free cash flow. Different from comparable company analysis, firm value estimated with DCF analysis is not influenced by the current market condition. Thus, the value based on DCF analysis is also called intrinsic value. In a DCF analysis, an analyst needs to do projections of future free cash flow, usually to a period of 5 years. Free cash flow is cash generated by a company after paying all cash expenses, but prior to the payment of interest expenses. An analyst also needs to estimate the terminal value of a firm. If we assume financial performance will enter a stable age at the final period, terminal value can be estimated with a perpetuity growth model. Terminal value can also be estimated through an exit multiple method, where terminal value equals a multiple of last period EBITDA. Future cash flow will be discounted by WACC. Terminal value can also be estimated through an exit multiple method, where terminal value equals a multiple of last period EBITDA. Future cash flow will be discounted by WACC, weighted average cost of capital. WACC represents the weighted average of the required rate of return of debt and equity. DCF serves as an important reference to check valuation implied by comparable company analysis. DCF is also feasible when it is hard to find comparable companies. But as you may have seen, the accuracy of DCF is subject to many assumptions, including future cash flow, terminal value, as well as WACC. Different assumptions may cause significant differences in the final valuation range. Okay, in this video, we have discussed comparable company analysis and DCF analysis. Thanks for watching. In the next week, we will continue our discussion with IPOs for more details.